I'm Natalie Trow of Elevation Wealth Partners, and this is the December Elevation Market Update. Today, I'm talking with Max Barnett of Janus Henderson. He has over 10 years of experience in the financial industry and joined Janus last year. He's based out of Scottsdale, Arizona.
Hey Natalie, how are you doing today?
I'm good, and we're excited to have you here for the market update.
I'm very excited to be here. Thanks so much for having me on.
Of course. So let's talk first about the economy in general and what happened in the markets this year.
Yeah, absolutely. I mean, when you look at basically the last 12 months, it's really hard to spin it any way other than it was a pretty good year to be an investor, right? Specifically, if you were allocated more towards, your risk assets such as stocks. So when we're looking at the performance of investments for 2024, stocks did exceptionally well, especially domestic stocks. So if you were invested in the S&P 500, that index was up about 30% this year, at least as of time of recording right now. So I think most of us would take a 30% return in a given year if it was offered to us, right? If we could get 30% in 2025, sign me up for that. I'll take that right now. So your domestic stocks did really, really well. Your international stocks didn't do quite as well, but they still did, gave you pretty moderate returns. Right now, international stocks are up about 8% year to date. So if you were invested in stocks, you probably are feeling pretty good right now about the performance of your portfolio for 2024. On the other side of the equation, fixed income is the other main asset class we're generally allocating to. And fixed income had good, not great returns, I guess is how we would put it. You did make money in bonds overall. And the biggest reason for that is because of the rate hikes that we have experienced over the last couple years. Bonds are yielding a lot more than they used to a couple years ago. So you got a better yield from your fixed income investments. At the same time, though, if we went back to 12 months ago, the general consensus was that we would see more rate cuts happen. And interest rates and the price of bonds actually move in opposite directions. So interest rates generally lead to interest rate cuts, I should say, generally lead to price appreciation for bonds. There were fewer interest rate cuts in 2024 than what was expected to happen at the beginning of the year. And that caused a little bit of price volatility for fixed income. Now, again, because yields were really strong to start off the year and yields continue to be strong right now, that price volatility was less than the total yield that we saw for fixed income. So most bond investors got, low positive returns. We're talking about probably 3 to 5% in 2024. So great year for stocks, good, not great year for fixed income, but overall a great year to be an investor. And the big reason for that being is that the economy did a lot better than what people were expecting if we go 12 months ago. At the beginning of this year, end of last year, most people, most economists, most analysts, most investors were thinking we were going to have what's called a hard landing, right? A recession as a result of the rate hikes that the Fed put into place in 2022 and 2023. Now the predominant belief is that we're going to see a soft landing. We've seen unemployment remain strong. We've seen earnings remain strong. As a result, the economy has done a lot better this year than what we thought. And that's the reason why you've seen your more risk assets like your stocks do a lot better than your more safe haven assets like your fixed income investments.
Yeah, so as a lot of our clients have seen, this year actually was really good in the markets, as you said. And even though there's been a lot of anxiety, with the election and everything that happens this year, so the big question on most people's minds is, what does a Trump presidency mean for the markets and for their accounts?
Yeah, absolutely. And before I answer that question, I just want to make it very, very clear we're only talking about what it means for the markets and investment accounts, right? We obviously want to elect the best president to create the best society for us here in the United States. A thing I like to say a lot is that the stock market is just one piece of the economy. and the economy is just one piece of our society. So I'm not making any commentary on whether or not I think the American people made, the right choice or the wrong choice when it comes to who was elected in November. But if we are looking at just the stock market, our belief, and it seems like, the broader industry's belief, is that the Trump presidency is likely going to be a positive thing in the short term for stocks. There are a lot of stimulative policies that he is likely going to put in place. Most notably is his tax policies. So while personal taxes are likely going to be unaffected by Trump coming into office in January, one of his main platforms has been to lower corporate taxes, which will be positive for the economy as a whole in the short term, in our opinion, at least. Long term is always harder to suss out than the short term. But will also especially be good for your small and mid-sized companies that don't have, the fleet of lawyers that a business like Amazon has to help skirt around corporate taxes. These tax cuts should be very, very positive for, your small and mid-cap companies, as well as just your smaller local businesses as well. So while the long term is a little bit more cloudy, we do think that we have a pretty positive view on the equity market and stocks in the short term as a result of this election decision.
All right. Yeah, it should be good for those companies. Let's talk next about trade and tariffs.
Yeah, absolutely. I mean, that's probably the biggest thing I think on people's mind, right? And the bottom line is that we are going to have to wait and see what the impact will be for individual companies right now. There's a lot of differing opinions out there. And the proposed tariffs, especially that we are looking at right now, are, if they do happen, will be unprecedented. So it is very hard to predict. The things that we are confident about, though, is that the tariffs in the short term should be inflationary in nature, right? So if we think about what a tariff is doing, if we can import goods from other countries, mainly China, for instance, and they're a lot cheaper, and then we slap a tax onto that to make them less competitive, whether we continue to import those goods and pay that tariff, or we shift more to more expensive goods here domestically, that will cause a little bit of an increase to the cost of goods. So as a result, what we think is going to happen is that we'll have a little bit more inflationary pressure. We don't think we're getting anywhere close back to the 2021 levels of 7% plus inflation, but it will have a little bit of upward pressure on inflation. And the big impact of that is less of just the inflation that we will see than it is what the Fed's response will be to that. So because the Fed is very, very focused on limiting inflation and making sure that we can get back down to that 2% level, we believe that the Fed is going to take a little bit more time for it to cut rates down to what is called the terminal rate, or essentially the level of interest rates that they feel is kind of the sweet spot for the economy to be in long term. Our belief is that that is about 3.5%, and it's going to take a little bit longer to get there since Trump got elected than we likely would have gotten to if Harris was elected. Bottom line is the Fed wants to risk keeping rates too high for too long and having the economy slow more than they would rather cut too soon and have inflation pop back up. So that's the approach that they're going to take. And there's a couple different impacts that could have on the economy and the market as a whole. We do think there will probably be a little bit of pockets of volatility, but like I said, we are still pretty constructive on the equity market.
Yeah, we definitely want to make sure that inflation doesn't get out of control again, right? We all hate going to the grocery store and all of a sudden our bill is much higher. So we just have to be patient on those rate cuts. So another thing that Trump has been very vocal about is changes to labor and immigration.
Absolutely. And this is kind of a dual-edged sword in terms of what we think its impact is going to be. First and foremost, again, a line that one of my colleagues said that I really liked is you have to take Trump seriously, but not literally. And so we will see as to if there are the amount of deportations that he has talked about on the campaign trail, or if that was more of just campaign rhetoric. But let's say that that is what happens, right? He does stick to what he said on the campaign trail, which we do think is probably, it's probably going to be a reduced version of this. But if we do see massive deportations, that will also be a little bit inflationary. However, at the same time, you'll have slightly deflationary forces because you're removing people from the demand pool as well. So we think that the needle would be slightly more on the inflationary side because you are removing that cheap labor, but the demand that is removed will also help offset that a little bit. So our opinion is that this probably has less of an impact on the overall economy as what we would expect to have happened for something that's gotten so much talk in the news.
Yeah, so zooming out a little bit beyond Trump, on a macroeconomic scale, what's your view on 2025?
Yeah, so positive. If we look at 2024, again, it was a great year for the economy and the stock market. So are we thinking that 2025 is going to be as great for investors as 2024? Honestly, probably not. But that's not because of issues in the economy. That's just because it's really, really difficult to match what we just saw. Really high returns, really low volatility. I'm a big basketball fan. I kind of look at 2024 as a player scoring, 50 points in a game. Are you expecting them to score 50 points in the next game, right? If, let's say, Kevin Durant scored 50 points in one game, is he going to score 50 points the next game? Probably not. Is he going to have a good game, though, the next game? Probably, because he's a really good player, right? And that's the way I look at our economy and our stock market right now. 2024 was a 50-point game. If we still have a great year next year, which is what we think is going to happen, we could absolutely see 15, 20, 25% returns in the realm of possibility. Obviously not a guarantee, but is certainly on the table. Bottom line is that when we're looking at everything, the economy looks really, really strong right now. I mentioned how unemployment is still fairly low. You're seeing the jobless claims tick up a little bit, but they're still well below average. While inflation isn't sub 2% like it was in the 2010s and may, peak up a little bit with Trump policies, the really scary numbers of 6, 7, 8% are very much dead and buried. And corporate earnings and personal financial statements still look really, really strong. The only thing that really concerns us is a potential unforeseen geopolitical event, like a black swan style event, right? The biggest concern for us right now is probably tensions in the Middle East. The good news is that a black swan event, which is something that is unforeseen, that really shakes everything up, is by definition always a possibility, right? Because it's unforeseen. So we never have black swan events not be a risk. If that is the only risk that we see being a major factor, then that's about as good of a situation as you can hope for. So when we're looking at 2025, again, we think there's not going to be as many rate cuts as were probably hoped for 3 to 4 months ago, which will likely lead to patches of volatility here. And we won't see as rapid growth next year as we did this year, especially as the economy starts to adjust to those higher interest rates. But again, I'll take a 30-point game if I can't get a 50-point game. And that's what we're expecting for 2025.
Absolutely. So, taking all of the things we've talked about into account, where is Janus Henderson seeing opportunities to invest?
Yeah, so there's two main areas. So first on the fixed income side of things, which we haven't talked about as much, but there's three main categories of fixed income: treasuries, corporate bonds, and securitized debt. And I think most people understand what treasuries and corporate bonds are. Securitized debt is the one where a lot of people are less familiar of, and in our opinion, has a lot more opportunity right now. So securitized debt is basically everything that isn't a treasury or corporate. So think about things like mortgages, asset-backed securities, so like car loans, things of that nature. The bottom line is that the corporate bond market has already essentially what we call priced in a soft landing, which means that the corporate bond market expects a soft landing to happen. The securitized market, on the other hand, hasn't gotten there yet. It's still kind of in between a hard landing and a soft landing. So in the event where a soft landing happens, you don't really get any benefit from corporate bonds from a price appreciation standpoint because they've already priced that in, whereas securitized bonds you would. On the flip side, if we actually had a hard landing happen, let's say I'm completely wrong about everything I just said over the last 15 minutes, and next year gets really, really choppy and we do have a hard landing, you already have a little bit of that priced in to securitized debt. So you won't see as much movement on the downside because they're already prepared for it, whereas corporate bond prices are not prepared for that. And then to tie a bow on that, you're actually getting more income while you wait for one of those two situations to play out with securitized debt. So it's just a really rare instance right now where you have less downside, more upside, and more yield. What's not to love in that versus corporates, right? So we are very much in the recommendation of being overweight securitized fixed income. And then on the equity side of things, we really like mid and small cap companies. So we all know those really large tech companies have done exceptionally well over the last few years, right? If you own Tesla, Nvidia, Amazon, Facebook, you've been a really, really happy investor. But a lot of these trends that I've pointed to are things that should help the mid and small cap stocks do well. And that's actually why you've seen them really do exceptionally well relative to large caps since the election hit. So right now, our recommendation is if you have a fixed income allocation, you should lean into securitized debt. And for your equities, maybe take some of those gains that you have in your large cap companies, especially your large cap tech companies, and allocate that a little bit more towards your mid and small caps, which we think will have a lot of opportunity for outperformance in the next year or two.
Yeah, and the good news is for our clients is that you are all diversified. So all the things that Max is talking about, those are things you already have in your portfolio. And everyone at Janus and the other fund managers, they sit there all day and they make the moves so you don't have to. So Max, do you have any last comments for us?
Yeah, I have one last comment that I've been saying a lot in the last probably 3 months, kind of leading up to the election and following the election, because the bottom line is the election has been what everyone cares about right now, and for understandable reasons. But the first thing is that before any election, we talk a lot about how it doesn't make sense to play politics with your portfolio. All the numbers back this up. There is no direct correlation between political parties and the return of the stock market. The bottom line is being invested is the right move to make the vast majority of the time. That being said, what I like to also say, what I said, before and post this election a lot, is that while pretty much all elections don't matter in the long-term scheme of things for investment portfolios, this one probably mattered less than any of them, which I get a lot of head tilts on because everything is so controversial these days and everyone thinks that everything is so different. But there have been two main trends that have really influenced what the market has done over the last 4 or 5 years. And those two trends have been government spending and where interest rates are based on what the Fed is deciding. And while these two candidates, Harris and Trump, were very, very different in terms of what their policies were, the one thing that they had in common is that neither of them are exactly budget hawks. They have no problem spending and operating at significant budget deficits, at least in the short term. So regardless of who got elected, now that spending may be diverted in different directions, but the spending happens. And as a result, that's the thing that matters most. And that's going to help the economy continue to grow, at least again, in the short term. The other thing also is just going to be interest rates. And regardless of who got elected, we're still seeing interest rate cuts happen. Now, I did mention, of course, that we're probably going to see them be a little bit slower cutting with Trump than with Harris. But the bottom line is that the direction of interest rates is what matters the most, and we're continuing to see them go down. So that's just kind of me on my soapbox of how we don't want to play politics with our portfolios. It's not timing the market, it's time in the market. The best, I think, financial advice I ever got was that your portfolio is like a bar of soap because the more you touch it, the smaller it gets. And I think that is very, very true with politics as well. So I would say that's my last comment. But again, we're very, very excited about where we feel the economy and the markets are headed in 2025. And looking forward to what we think will be another good year. Even if it doesn't quite live up to 2024, it's still going to be a year that you're better off being invested than not.
Absolutely. So, Max, thank you so much for joining us today and sharing your insights with us. I hope that everyone found this helpful. If you do have a question that we didn't answer, feel free to reach out to our office and we can chat. Our next elevation market update will be in January. So until next time.